Over the past few years, the average homeowner has built tens of thousands of dollars in equity. And when they sell, a lot of them quietly give a chunk of it away in taxes. Not because they have to, because they didn't know they didn't have to. There's a rule built into the tax code that can shield up to $500,000 of profit from capital gains. But most people don't fully understand how it works, or when it applies. So they sell, assume they owe more than they do, and lose money they could have kept. And the frustrating part is, by the time you realize it, the decision is already made. In this video, I'm going to walk you through exactly how this rule works and where people get it wrong. So when you sell, you keep more of what you already earned, instead of handing it back simply because no one explained it clearly. There's a version of this story that almost every homeowner has absorbed without ever being taught it directly. You buy a home, you live in it, and if it goes up in value, you owe taxes on the profit when you sell. It feels like a logical extension of how taxes work everywhere else in your financial life. You make money, you pay a cut. The government takes its share, and that's how it works. That version of the story is so widely assumed that most homeowners never think to question it. A 2024 national tax literacy poll conducted by the Tax Foundation surveyed more than 2,700 American taxpayers and found that more than half lacked basic tax literacy, and only 2% demonstrated what researchers considered proficient tax knowledge. These are not careless or irresponsible people. These are people who file every year, own homes, have retirement accounts. They just were never shown this particular corner of the tax code because nobody had a financial incentive to show it to them. The belief runs even deeper than that. When most homeowners think about selling, they think about the capital gains rate, which is the percentage they expect to owe on the profit. They factor that bill into their plans. Some delay selling because of it. Some make major life decisions, like when to retire or where to move next, based on a tax bill that they were never actually required to pay. The assumption of inevitability is doing real damage here, and it's doing it quietly over long periods of time to the people least likely to push back on it. What you almost certainly weren't told when you bought your home, and what you probably haven't been told since, is that the federal tax code has an explicit exclusion written into it specifically for this situation. Not a gray area, and not a technicality. A written, codified, congressionally approved exclusion called Section 121 of the Internal Revenue Code. It says you can make up to $250,000 in profit on your primary residence and owe zero federal capital gains tax on it. If you're married and filing jointly, that number doubles to $500,000. This has been the law for nearly 30 years. The reason you don't know it is not that you missed something. The tax code runs nearly 4 million words, and nobody is legally or professionally responsible for making sure you understand the parts that help you. Your lender doesn't explain it at closing. Your real estate agent is focused on the transaction, not your federal tax liability. The IRS puts the information in a 50-page publication called Publication 523, which is technically available to everyone and practically read by almost no one. The system built a benefit for ordinary homeowners, then distributed it in a format designed for tax attorneys. Let's put a real number on this so it lands. The median U.S. home price increased by more than 57% over the past 5 years, according to the Federal Housing Finance Agency. If you bought a home for $350,000 5 years ago and it's now worth $550,000, you're sitting on a $200,000 gain. Without the Section 121 exclusion, that $200,000 would be subject to long-term capital gains tax at somewhere between 15% and 20% depending on your income. That's a tax bill of $30,000 to $40,000 on money you made by doing nothing except owning your home and waiting. With the Section 121 exclusion, for most people, that bill is zero. Here's how the rule works. You qualify for the exclusion if you've owned your home and used it as your primary residence for at least 2 of the past 5 years before the sale date. The 2 years don't have to be consecutive. You don't have to reinvest the proceeds into another home. You don't have to be a first-time seller. You don't have to be a certain age. You just have to have lived there. Single filers can exclude up to $250,000 of gain. Married couples filing jointly can exclude up to $500,000. And you can use this exclusion repeatedly, once every 2 years, for every primary home you ever sell for the rest of your life. That last part is the one that tends to stop people. You can use it more than once. Every 2 years for your entire life, every time you sell a primary residence, you get to exclude up to $500,000 in gains from your federal taxable income. The IRS wrote this into the code in 1997 as part of the Taxpayer Relief Act. It replaced a much more restrictive old rule that only let you do this once, and only after you were over 55. The version that replaced it is dramatically more generous, and it is dramatically underused. Federal Reserve data shows that total homeowner equity in the United States reached $35 trillion by mid-2024. The average mortgage-holding homeowner sits on roughly $300,000 in equity right now, according to Bankrate data from the first quarter of 2025. The potential tax savings for homeowners who understand Section 121 before they sell are not minor line items. They're the kind of numbers that change when people retire, how much they can leave behind, and whether the equity they spent years building actually stays with them. You might be wondering why something this concrete, this old, and this clearly written into federal law isn't common knowledge. The question has a behavioral answer, and the answer is not that people are careless or uninformed. The first piece is what psychologists call the availability heuristic, which is the tendency to judge how common or important something is based on how easily examples come to mind. Most people have a vivid mental image of owing taxes on income. Every paycheck, money disappears before it reaches your account. Tax season is a recurring, visible, often stressful annual experience. But selling a home happens a handful of times in a lifetime at most. The tax implications of that sale don't enter your awareness until you're already in the middle of it, and by then you're often getting information from a real estate agent or a title company, not a tax professional who would flag the exclusion unprompted. The second piece is what researchers call the default effect, which is the tendency to accept whatever assumption is already in place rather than actively searching for an alternative. If you assume a tax bill is coming, you don't look for a way out of it. The default assumption that home sale gains are taxable sits unchallenged in most people's minds because nobody prompts them to challenge it. The Tax Foundation's 2024 National Tax Literacy Poll found that more than half of American taxpayers couldn't explain how basic tax concepts work. The Section 121 exclusion is not a complex concept at its core. It's a 2-year rule with a dollar cap. But it lives in a part of the code that nobody teaches, and from the outside it looks exactly like the kind of rule that must have a catch buried somewhere deep in the fine print. The third piece is specifically about language. The word loophole carries connotations of something illicit, a workaround or a trick the wealthy use while everyone else plays fair. Section 121 is nothing like that. It's an explicit policy decision made by Congress, deliberately designed to help ordinary homeowners build and transfer wealth without being taxed on the appreciation they earned. But because the word loophole gets attached to anything that reduces a tax bill, a lot of people who hear about this rule for the first time assume there's a catch, decide it probably doesn't apply to their situation, and don't follow up. That combination produces the outcome we see. A cognitive bias that makes the unfamiliar feel untrustworthy, a default assumption of taxability that nobody prompts you to challenge, and language that triggers skepticism even when the underlying information is completely legitimate. A provision worth tens of thousands of dollars to the average homeowner, sitting unclaimed year after year because the brain decided it was probably more complicated than it looked. The system gave you a benefit. The way the system chose to communicate that benefit made sure you'd probably miss it. There is a specific kind of financial pain that doesn't announce itself until there's nothing left to do. The homeowners who get hurt by not knowing about Section 121 are not the ones who bought recently and have been actively tracking their options. They're the ones who bought in 2012 or 2015, who have been sitting on a home that has nearly doubled in value, who are now in their late 30s or 40s thinking about upsizing or downsizing or finally moving to the city they've been talking about for a decade. They've run the math on what their house is worth. What they haven't done is run the tax math, because they assumed the tax outcome was already fixed. This is where the identity layer becomes visible. Most people who own a home think of themselves as financially responsible. They file on time, they pay what they owe, they don't look for angles. They play by the rules. And because they've always played by the rules, they've never learned which rules were actually written in their favor. Research on what behavioral economists call identity protective cognition shows that people who see themselves as responsible and informed are actually less likely to seek out information that would challenge their existing assumptions, because updating would require admitting they didn't already know something they feel they should have. So the homeowner who has done everything right, who bought a home, maintained it, paid the mortgage, built equity responsibly over 12 years, is often the last person to know about the exclusion that was designed precisely for them. They find out at closing. Or they find out at a dinner table from someone who just sold their house and walked away from a $400,000 gain without owing $1 in federal capital gains tax. That moment has a specific feeling attached to it. It isn't anger at the IRS. It's the quiet, deflating realization that the opportunity was always there, and the only thing standing between them and it was a paragraph of tax code they were never handed. The Minneapolis Federal Reserve's analysis of American housing survey data found that homeowners' median housing equity went from $179,000 in 2019 to $254,000 in 2023, a 42% increase in housing wealth in 4 years. The gap between what responsible homeowners thought they owed and what the code actually requires for the homeowners who didn't know about the exclusion has never been wider than it is right now. And because home values across the country have continued appreciating well above historical norms, the dollar value of that gap grows with every year a homeowner remains unaware. If you own a home, what we've been covering applies to you directly. And if this is raising more questions than you had when you started watching, that's exactly why subscribing matters. Hit like and subscribe. Let's keep going, because the flexibility inside this 2-year rule runs considerably further than most people realize, and that's where the real missed opportunity sits. The reason the tax code doesn't make this easy isn't malicious. The issue is structural, and has been since the code was first written. The Internal Revenue Code was never designed as a reference guide for ordinary people making ordinary life decisions. It was designed to be comprehensive, legally precise, and internally consistent. That means a provision as practical as Section 121 sits in the same dense legal language as obscure corporate depreciation schedules. The law is accessible in theory. The information is practically unavailable to anyone who isn't already looking for it. So let's walk through what you need to understand, because the flexibility in this rule extends well beyond the 2-year headline. The 2-year residency requirement doesn't have to be the 2 years immediately before you sell. The look-back window is 5 years. If you lived in your home as your primary residence for any 2 years out of the 5 years before the sale date, you qualify. That means you can move out, rent the property for up to 3 years, and still claim the full exclusion when you sell, as long as you lived there for at least 2 of those previous 5 years. The 2 years don't have to run consecutively. A year in 2020 and a year in 2022 adds up to 2 years. If you sell in 2024, you qualify. If you haven't yet reached the 2-year mark and something forces you to sell early, a job relocation, a health situation, or another unexpected change, the IRS allows for a prorated partial exclusion. The calculation is based on how long you actually lived there relative to the 2-year requirement. If you've been there for 12 months of the required 24, you can exclude half the maximum. For a single filer, that's $125,000, and for a married couple, it's $250,000. The IRS explicitly names job changes, health circumstances, and what the code calls unforeseen circumstances as qualifying reasons for the reduced exclusion calculation. There's also a provision that almost no one knows about before it's too late to use it. If your spouse has died and you haven't remarried, you have 2 years from the date of their death to sell the property and claim the full $500,000 joint exclusion rather than the $250,000 single filer cap. The window closes at 2 years from the date of death, not from when the estate settles. Most people navigating grief and estate logistics are not tracking a tax deadline that expires within 2 years. Most of them find out about it when the window has already closed. The documentation that protects you here is simpler than most tax provisions require. The IRS needs you to demonstrate ownership and primary use. Mortgage statements, utility bills, voter registration, tax returns showing the property as your primary address. There's no separate form to file to claim the exclusion. There's no formal appraisal to commission. For the majority of homeowners whose gain falls under the exclusion limits, the only thing required is knowing this exists before the day you sign the transfer papers, not after. The gap between people who know this and people who don't is not a gap in income or education or financial sophistication. It's a gap in access to information that the system chose not to actively distribute. Remember that $75,000 figure from the opening. That's the median equity gain over 5 years. The National Association of Realtors found that homeowners who've been in their homes for a decade built average equity of nearly $150,000 through price appreciation alone, separate from anything they paid down on the mortgage principal. In high appreciation markets like coastal metros, growing Sunbelt cities, and the suburbs of major employment centers, that figure runs substantially higher. Now run the actual math on a real scenario. A married couple bought a home in 2014 for $350,000. They sell it today for $720,000. They have a $370,000 gain. Under standard long-term capital gains rates, they're facing a tax bill somewhere between $55,000 and $74,000 depending on their income level. With Section 121, they owe nothing on that entire gain because it falls under the $500,000 joint exclusion. The difference between knowing this rule and not knowing it in that single transaction isn't a rounding error. It's a full down payment on their next home. It's 7 or 8 years of maximum IRA contributions. It's the money that was supposed to carry them into the next chapter of their lives, and it would have silently been rerouted without their awareness. The compounding nature of what's at stake is the part that rarely gets said out loud. Because the exclusion resets every 2 years, a homeowner who understands this rule and plans their moves accordingly doesn't benefit once. They benefit across their entire lifetime of home sales. Each primary residence every 2 years up to $500,000 of gain excluded from federal taxable income. The wealth-building difference between knowing this rule and not knowing it, measured across a lifetime of home sales in a rising housing market, is not a marginal advantage. It is a completely different financial trajectory. And it has nothing to do with investment sophistication. It has everything to do with whether someone told you. The National Financial Educators Council found that financial illiteracy cost Americans an estimated $388 billion in 2023, roughly $1,500 per person. That's the diffuse, spread-out cost of not knowing. The Section 121 exclusion is the concentrated version of the same problem. One provision, one transaction, and a difference of tens of thousands of dollars for the ordinary homeowner who happened to find out in time. You are not overpaying because you chose to. You're overpaying because a system that could have told you this at any point, when you bought, when you refinanced, when you filed your taxes every year for the past decade, decided that wasn't its job. That's not a personal failure. The system was not built to make sure you kept what was yours. And the moment you see that clearly, saving stops feeling like something that requires perfect timing. It starts feeling like something the system kept from you, that you're now taking back. So if you own a home and you're anywhere in the range of thinking about selling someday, even a decade from now, this is the piece you needed. The system is not transparent, and it was never designed to hand you the information that reduces your tax bill. That has been true since the code existed. You are not behind because you didn't know this. You're behind because the system built a benefit for you, buried it in 4 million words of legal text, and waited to see if you'd find it. That changes the moment you understand it. If this opened up more questions than it answered, specifically around what happens at the edges of this rule, how it interacts with rental income or partial home office use, and what else is sitting in the code that most homeowners never think to ask about, that's exactly what the next one covers.